The market is a device for transferring money from the impatient to the patient. This is kind of a proverb reminding us that temporary downsides aren't an obstacle, but a necessary stepping stone towards maximizing profits. Buffett, of course, was talking about the stock market and wouldn't touch crypto with a 10-foot pole, but the question remains, does it ever make sense to sell? What does the research actually say? HODLing is more than just closing your eyes and white-knuckling it until CoinMarketCap turns green. There are two main reasons why you'd never sell your crypto. One, you believe in how the project will come to define the future of the global economy, and two, you want to make money. As much of it as you possibly can. And I don't judge either way, you do you, but hold on a second, because it's too easy to yell HODL, dollar cost average, and buy the dip. It's never quite that easy in practice. So instead, I want to arm you with the knowledge of strategies that you can take and how they compare profit-wise. This way, you can sleep a little bit better at night knowing that the crypto in your wallet deserves to be there. It's pretty clear that crypto hasn't managed to shake stock market moves. Fears in the stock market almost always translate to fears in crypto. That is in the last 2 years anyways. Whether it makes any sense or not, that's how things work. It's also true that altcoins rise and fall based on Bitcoin's performance. I like to think of it like gravity. So let's picture Bitcoin as the sun. Small altcoins are then planets that are affected by Bitcoin's mass and movement. But if Bitcoin is the sun, that makes the equities markets like the Milky Way, whose even larger gravitational pull can sway even Bitcoin. Sure, hype, FOMO, or the occasional tweet from a billionaire can allow a project to break free from the gravity for a while, but gravity is a big bitch, and it always wins in the long run. The good news is that some projections put Bitcoin reaching $200,000 in the second half of 2022. They literally call it a powder keg that could explode to 5x based on the fact that 75% of Bitcoin's total supply is being kept in storage. Basically, the thought is that there's such a limited supply of available Bitcoin, it would take an institution just purchasing 200,000 Bitcoin to increase the asset's value by at least 3 times. Now, predictions don't always work out, and that one in particular is banking on someone dropping nearly $10 billion on Bitcoin. But if they do, you'll want to know this: the best days theory. And this isn't the theory saying that you peaked in high school. This theory says that you shouldn't try to time the market. But why? It turns out that if you miss out on the 10 best performing days in an asset's history, your return is dramatically decreased. In fact, this can actually take your return from positive to negative. Take a look at this chart. In the 1980s, the S&P returned 227% over 10 years. By my math, there's more than 3,000 days in a decade. If you missed out on just 10 of the biggest gainer days, your return for the entire decade is more than cut in half. Short-term traders in crypto will argue that day trading is the only way to make real profit in this market, which, don't get me wrong, that can work, especially if you're really familiar with one asset and its price movements. But this underestimates the time it takes to really watch and study market movements, not to mention the stress. For a trade to be worth you spending all day staring at a screen, it has to be a dollar amount that's significant to you. That's stressful. I mean, my heart rate is already high enough sitting here drinking coffee all day long. You know, this works for some, but for most people, that's just too much emotion to fit into your average Tuesday. So it seems for a normal human, time, not timing, is what matters most over the long run, which is great because that's actually less work. I mean, who doesn't want to do less work? But there are different levels of passively HODLing. A few studies have come out that challenge the idea that holding through thick and thin is the best. The best days theory works because we have stock data all the way back from before your grandparents were born. Newer strategies have come out that may outperform the white knuckle fever dream that passive HODLing can be. So a study by Investopedia compares the buy and hold approach to a more active strategy called constant mix. Here's how the study was set up. Group 1, the HODLers, would buy an allocation of stocks and bonds at a 60-40 split, just a classic stock and bond allocation, and hold them no matter what happens in the market. Group 2, the constant mix, would buy the same 60-40 split, but then they would constantly rebalance to keep the portfolio right at 60-40. If stocks go down, you'd move some bond money over to the stocks to get that back up to 60%, and vice versa. You get it. What's important is the results. They were peculiar. It turns out that in a long trending market, whether up or down, the buy and hold strategy has a better return. But it gets more complex in an oscillating market. This just means a market where things are more unpredictable. You know, big reversals followed by big surges in price. When things are crazy and unpredictable, constant mix actually beats out HODLing. The reason being is we're emotional. This is also the reason why I've been trying out one of those, gimmicky like beard roller things, because I'm getting tired of being cyberbullied for my patchy beard. and I'm just trying to do everything I can about it. But either way, this strategy essentially systemizes buying dips and selling profits while completely taking out those pesky emotions from your decision making. The reason I bring this up is an oscillating market sounds a whole lot like crypto in general. An uptrend over time, but a whole lot of volatility along the way. So if your goal is to maximize your profit, it seems like committing to a portfolio balance could be the right way to go. So I sat there and I thought on this for a while. How could this strategy be applied to crypto? See, it works well for stocks and bonds because those assets typically move in opposite directions. When one is doing well, the other typically isn't because they're essentially fighting for the same dollars from investors. So I was trying to figure out what does well when crypto is down, because you want to be in crypto, but again, Bitcoin's gravity means altcoins move in the same direction, so it's not quite the same as stocks and bonds. And then it hit me. Lending. It's not the exact same, but the principles are similar. This rebalancing strategy could work extremely well with lending and holding crypto of your choice. You could, for example, lend out 40% of your portfolio in stablecoins for 10 to 20% interest, and then the remaining 60% be in cryptos of your choice. Then every 2 weeks or once per full moon or however you want to do things, you rebalance it back to that 60-40 split. But it doesn't end here, because we have another study by Shrimpy that goes even deeper. And this time it's specifically a study on crypto. So here's how it worked. They took crypto from the bear market between January 2018 and January 2019 and built portfolios of cryptos ranging between 2 and 18 random assets. And each of those 5 portfolios were duplicated and rebalanced over different time intervals ranging from 1 hour to monthly. The goal was to then compare those 20 portfolios to the results of the same cryptos with no rebalancing whatsoever. So baseline performance versus rebalancing. Not to sound like a BuzzFeed article, but the results were shocking. The clear winner by a huge margin was daily rebalancing. It did best for every single portfolio size and significantly better than holding outright. The percentages shown here is the performance over simply holding the same cryptos. What they found is the more often things are rebalanced, the better. However, there is a speed limit because the more you trade, the more trading fees you incur. This is why hourly rebalancing perform worse than daily. And they also found out that the more assets you hold is also generally better. Now, it is important to note that they chose random cryptos, so your portfolio may end up with completely different results. But the question is, should you regularly rebalance your portfolio? And chances are, it wouldn't hurt. And thankfully, it's the 21st century and you don't have to manually rebalance yourself every day if you don't want to. Pionex has a bot that auto rebalances your portfolio with up to 10 different coins. Here you click Rebalance Bot, multi-coin mode, customize, choose your favorite crypto gems, choose how much you'd like to invest, click Advanced Settings, turn on Rebalance because that's why we're here. And then you can see that they only go up to 4 hours, which isn't a big deal because their fees are super low at only 0.05%, but you can limit that even further by changing the rebalance mode to threshold. There you can allow the bot to only rebalance after set price changes. So ponder what you'd like to do and click create. Then from there you can click detail and see everything you need to know about the portfolio. It's pretty darn handy to use, and I'm going to use this bot and just see how it does. Pionex will also be linked in the description. If you use that link, you'll get even lower trading fees. But all of this leaves us with one glaring question. If it's best to just buy and hold forever and perhaps rebalance, when should you sell? I mean, at the end of the day, the point of investing is to make money and then do the things you want to do with that money. I mean, I still got my eye on that 18th century samurai armor. But what if I told you that it's possible to do both, to HODL and buy 18th century samurai armor? There's a story of Larry Ellison. He owns 22% of this little corner shop you may have heard of called Oracle. His ownership here has made his net worth absolutely massive, but he has a problem. If he wants to use any of that money to, I don't know, get in the billionaire space race or whatever billionaires want to spend their money on, he has to sell his shares. What he did instead of selling was use his shares as collateral to take out a line of credit at the bank, a line with $22 billion as the limit. His strategy made him the most indebted person alive. But this does something interesting. It means he never has to sell his shares, meaning he never has to pay capital gains tax, and he still gets to use that money. The beauty is anyone can take this same strategy. It can be done pretty simply on most crypto exchanges, locking up some crypto and then borrowing against it. Or in DeFi, you can take things one step further. Take this example on the Yearn protocol. You can take the stablecoin USDC and deposit it for an average yield of around 7%, earning you money on your cash. When you deposit your USDC, it turns into YVUSDC. This is called a yield-bearing collateral, basically a receipt of your deposit that in itself is worth money and is making money. Now you take your YV tokens to the Abracadabra protocol, pledge them as collateral, and borrow MIM tokens against it, another stablecoin. Just stay with me here. What's great about this is that the interest that you'd have to pay on the borrowed MIM is way lower than your return on that USDC deposit. So theoretically, your yield sits at 6.2%, and you still have those stable coins that you can then use to buy more crypto, sell for cash, or spend however you like. Now, of course, this is an advanced strategy. Please do your own due diligence, and there is added risks if you're using collateral that has some volatility. But the point is, in DeFi, you can have your crypto and spend it too. So if you learned anything new, don't forget to hit the subscribe button. It's free, and you can always change your mind later. And I'd just like to thank you so much for watching, and I hope you have a profitable day.